People always ask me how I saw the dot-com bubble coming years before it burst in 2000, how I predicted the Japanese asset bubble would collapse a decade before it happened, how I knew the housing bubble was unsustainable long before 2008. They think it's some kind of magic, some secret formula, or insider information that only billionaires have access to. But the truth is much simpler and much more disturbing. Bubbles follow the same psychological patterns every single time. The same warning signs appear in the same sequence. The same delusions spread through the markets in predictable waves. And yet, every generation of investors convinces themselves that this time is different. I've witnessed 14 major market bubbles in my 60-year career. From the early commodity bubbles of the 1960s to the tech mania of the late 1990s to the housing madness that nearly destroyed the global financial system. And every single one followed an identical script. The most profitable and most terrifying thing I've learned is that bubbles are not accidents. They're not random events caused by unpredictable market forces. They're systematic psychological phenomena that emerge from fundamental flaws in how human beings process information and make financial decisions. Here's what most people don't understand. Bubbles don't burst because of external shocks or sudden bad news. They burst because they reach a mathematical point where the delusion becomes impossible to maintain. And that point is predictable if you know what warning signs to watch for. Today, I want to share with you the 5 warning signs that have allowed me to identify every major bubble years before they peak and collapse. These aren't technical indicators or economic theories. These are psychological and social patterns that repeat with clockwork precision in every speculative mania throughout history. Because here's the uncomfortable truth. We are living through multiple bubbles right now. In technology stocks, in real estate, in government debt, in asset prices across the board. And the same warning signs that preceded every historical bubble are flashing red today.
The question isn't whether these bubbles will burst. The question is whether you'll recognize the warning signs before it's too late, or whether you'll be caught in the same psychological traps that destroy wealth on a massive scale every generation.
Warning. Sign number 1. When new era thinking takes over. The first warning sign of every bubble is the emergence of new era thinking, the widespread belief that fundamental economic laws have been permanently suspended by revolutionary changes in technology, policy, or social organization. This delusion provides intellectual justification for ignoring traditional valuation methods and risk management principles. I first encountered this during the 1960s growth stock bubble, when investors convinced themselves that certain companies had discovered the secret to perpetual growth. Companies like IBM, Xerox, and Polaroid were trading at price-to-earnings ratios of 50, 80, even 100 times earnings, and investors justified these valuations by claiming these companies would grow at 20 to 30% annually forever. I remember attending investment conferences where seasoned analysts presented mathematical models showing how these companies could maintain exponential growth indefinitely. The complexity of business cycle analysis was reduced to simple narratives about technological inevitability and superior management systems. The flaw became obvious during the 1973-74 bear market, when these one-decision stocks fell 60 to 90% as investors rediscovered that no company can grow faster than the overall economy indefinitely. But the psychological pattern had been established, and I watched it repeat in every subsequent bubble. The Japanese asset bubble followed the same script. Investors convinced themselves that Japanese management methods had transcended normal economic limitations. The Tokyo stock market traded at 60, 80 times earnings, and Japanese real estate reached levels where the Imperial Palace grounds were theoretically worth more than all California real estate. The justification was always identical. Japan was different. Japanese companies had longer time horizons. Japanese workers were more dedicated. Traditional valuation methods didn't apply because Japan had transcended normal capitalist limitations. What I found during months of research in Tokyo was a complete disconnect between the mathematical requirements for these prices to be justified and the actual productive capacity of the Japanese economy. For these valuations to make sense, Japan would need to achieve productivity growth rates never sustained by any economy in human history. When the bubble collapsed in 1989-90, The Nikkei fell from 39,000 to below 15,000, and Japanese real estate lost 70% of its value. The supposed superiority of Japanese methods proved largely illusory. But the most spectacular example was the dot-com bubble. Internet companies with no revenue traded at billion-dollar market capitalizations because investors believed digital technology had fundamentally transformed business economics. Traditional metrics like profit were declared obsolete, replaced by eyeballs and network effects. I watched companies with zero revenue trading at market caps of billions. Investors paid $400 for shares in companies that had never made a penny of profit. The justification was always the same. The internet changes everything. Old valuation methods don't apply. The mathematical impossibility became clear when I calculated that for these valuations to make sense, internet companies would need to capture exponentially growing shares of an exponentially expanding economy. The implicit assumption was that the internet would increase overall economic growth rates so dramatically that traditional companies would become obsolete. When the bubble burst in 2000-2002, the Nasdaq fell 78%, and hundreds of internet companies disappeared entirely. The survivors took years to grow into valuations that had been based on pure speculation. Here's how to identify new era thinking. Listen for phrases like paradigm shift, new economy, or old rules don't apply. Watch for widespread dismissal of traditional valuation methods. Remember that while innovation creates opportunities, it cannot suspend basic laws of mathematics or human psychology. Warning sign number 2, credit expansion accelerates beyond income growth. The second warning sign is when credit expansion accelerates far beyond the growth rate of underlying incomes and economic output. This creates artificial demand that pushes asset prices above levels sustainable by normal economic activity. Every major bubble has been fueled by excessive credit creation that temporarily allowed people to buy more than their earning power supports. I learned to watch credit flows more carefully than any other indicator when assessing bubble risk. The Japanese bubble perfectly illustrated this dynamic. Following the 1985 Plaza Accord, the Bank of Japan lowered interest rates to historic lows, creating massive cheap credit that flowed into stocks and real estate. Banks made increasingly generous loans against appreciating collateral, creating self-reinforcing cycles of credit-fueled speculation. The mathematics were obviously unsustainable. Land values in Tokyo reached levels where the Imperial Palace grounds were worth more than all California real estate. Total Japanese real estate reached $20 trillion, 4 times all U.S. real estate value, despite Japan having half the population and much smaller land area. These prices could only be maintained if credit expansion continued accelerating indefinitely, but credit cannot grow faster than income forever because borrowers eventually become unable to service debts. The bubble burst when the Bank of Japan tightened policy and credit growth slowed. The 2008 housing bubble followed identical patterns, but on a larger scale. Between 2000 and 2006, U.S. mortgage debt doubled from $5 trillion to $10 trillion, while median incomes stagnated. Home prices rose 50 to 100% in many markets, far exceeding wage or rent growth. When I examined the mathematics, the bubble was obviously unsustainable. For home prices to continue rising faster than incomes, either mortgage payments would consume ever-increasing household budget shares, or credit terms would become progressively more generous to maintain affordability. Both trends were clearly visible. Average home price to income ratios reached unprecedented levels, and lenders offered ninja loans with no income verification, interest-only payments, and artificially low adjustable rates. These weren't financial innovations. They were signs that normal lending standards had been abandoned. When credit standards tightened and the Federal Reserve raised rates, the bubble collapsed because artificial demand created by excessive credit disappeared. Home prices fell 20 to 50% in many markets. The pattern extends to every asset class where bubbles form. The corporate debt bubble of the 1980s was fueled by junk bond financing that allowed unsustainable debt levels. Emerging market crises of the 1990s were caused by excessive foreign borrowing that required continued currency stability and uninterrupted growth. Here's how to identify dangerous credit expansion. Compare debt growth to GDP, wages, or economic capacity. When credit consistently grows faster than income for several years, you're witnessing artificial demand creation that will eventually disappear. Watch for financial innovations that allow more borrowing with less documentation, smaller down payments, or longer repayment periods. Pay attention when credit growth accelerates during asset price appreciation, creating self-reinforcing cycles that always end in deflationary collapse. Remember, sustainable growth requires credit expansion, aligned with productive capacity and real income growth. When credit grows much faster than the underlying economy, it creates artificial demand that will eventually disappear. Warning sign number 3, price increases become self-justifying. The third warning sign is when rising prices begin creating their own justification through reflexive feedback loops between market perceptions and economic reality. This is the essence of my reflexivity theory. Markets don't just reflect reality, they shape reality through feedback mechanisms, creating self-reinforcing boom and bust cycles. Traditional economic theory assumes markets reflect objective fundamentals, but I've learned this assumption is fundamentally flawed. In bubble conditions, market prices begin influencing the fundamental conditions supposed to determine those prices. The clearest example from my experience was the 1960s conglomerate bubble, where stock prices created their own fundamental justification through merger accounting. Companies like Litton Industries used inflated stock as acquisition currency, and each acquisition temporarily boosted reported earnings per share, justifying even higher stock prices. High stock prices gave these companies expensive acquisition currency, allowing them to buy companies with lower price-to-earnings ratios. Accounting rules then allowed them to report higher consolidated earnings per share, which justified the high stock prices, enabling more acquisitions. This created feedback loops where rising stock prices enabled acquisitions that boosted reported earnings that justified higher stock prices. Investors bought conglomerate stocks because they were rising, and they kept rising because investors were buying them. Underlying business performance became almost irrelevant. I realized this system could only continue as long as stock prices kept rising, because the entire earnings growth story depended on continued acquisitions, which depended on maintaining high stock prices. When stock prices stopped rising, companies lost their ability to make earnings-enhancing acquisitions. The bubble burst when investors realized reported earnings growth was largely an accounting illusion created by acquisitions themselves, not improved business performance. But the most spectacular example was the housing bubble. Rising home prices created multiple self-reinforcing mechanisms that temporarily made price increases appear rational and sustainable. First, rising prices improved bank balance sheets by reducing loan losses and increasing real estate collateral value. This allowed banks to make more loans on more generous terms, increasing demand and pushing prices higher. Second, rising home prices made homeowners feel wealthier, encouraging increased spending and borrowing against home equity. This consumer spending boosted the overall economy, increasing employment and wages, supporting further home buying and price appreciation. Third, rising prices attracted speculative buyers purchasing homes purely as investments, betting on continued appreciation. This investment demand pushed prices even higher, appearing to validate the original investment thesis. Most dangerously, rising home prices were cited as evidence the housing market was healthy and lending standards could be relaxed further. Regulators and politicians pointed to continued price appreciation as proof their policies were working, even though those policies were creating the price increases they cited as justification. I watched this reflexive cycle accelerate throughout the mid-2000s. People bought homes they couldn't afford, expecting appreciation to improve their finances. Lenders made risky loans because collateral values were rising. Policymakers encouraged more lending because housing prices were rising. The mathematical impossibility became clear. For this cycle to continue indefinitely, home prices would need to rise faster than incomes forever, eventually consuming 100% or more of household budgets. When the cycle reversed, the same mechanisms that amplified the bubble amplified the crash. Falling prices weakened bank balance sheets, tightening credit and reducing demand. Homeowners felt poorer and cut spending, weakening the economy. Speculative buyers disappeared. Here's how to identify dangerous reflexive feedback loops. Look for situations where rising prices justify the policies or behaviors causing prices to rise. Watch for market participants citing recent price appreciation as evidence their investment strategy is working. Pay special attention when rising asset prices improve the financial capacity of institutions that directly influence those same asset prices. Warning sign number 4. Amateur speculation dominates markets. The fourth warning sign is when amateur speculators begin dominating market activity, driven by the belief that investing requires no special skill because markets only go up. This democratization of speculation is a late-stage bubble phenomenon signaling professional money has exited and retail euphoria is driving unsustainable prices. I've observed this pattern in every major bubble, always unfolding in the same sequence. Early in bubbles, professional investors drive price appreciation based on genuinely improved fundamentals. But as prices rise and media coverage intensifies, amateur investors are attracted by the apparent ease of making money. The transformation occurs when financial media begins promoting the idea that traditional investment analysis is obsolete and ordinary people can achieve extraordinary returns through simple strategies. This is accompanied by stories of regular people who quit their jobs to trade full-time or achieved financial independence through lucky market timing. During the 1960s growth stock bubble, I watched housewives, taxi drivers, and bartenders discuss stock tips with seasoned analyst confidence. The Nifty 50 stocks were promoted as one-decision investments requiring no analysis. You simply bought and held forever because these companies would grow indefinitely. Democratization peaked when mutual fund sales exploded and investment clubs formed in every community. People who had never read financial statements made investment decisions based on magazine articles and cocktail party conversations. But the most dramatic example was the late 1990s day trading mania, when millions of amateur speculators convinced themselves they could achieve professional-level returns, trading technology stocks from home computers. The media promoted stories of ordinary people making thousands daily through day trading. I watched CNBC broadcasts interviewing housewives and retirees claiming 50 to 100% annual returns. Online brokerages advertised that anyone could quit their job and trade for a living. The underlying assumption was that professional investment managers were dinosaurs who didn't understand the new economy, and technological access had leveled the playing field between institutions and individuals. The mathematical impossibility should have been obvious. If millions of untrained amateurs could consistently outperform professionals with decades of experience and billion-dollar research budgets, either professionals were completely incompetent or markets were completely inefficient. Studies showed 90% of day traders lost money even during the greatest bull market in history. But these losses were hidden by overall market appreciation, making even bad picks temporarily profitable. The housing bubble created similar dynamics in real estate speculation. Television shows promoted house flipping as easy money, and seminars promised to teach ordinary people real estate millionaire secrets. Construction workers and teachers began buying multiple properties with no money down. Here's the key insight. When complex markets appear simple and accessible to everyone, bubble conditions are masking risks and complexities that normally require professional expertise. Amateur speculation dominance creates dangerous dynamics that accelerate bubble formation and make crashes more severe. It removes informed selling pressure, creates herding behavior, and builds enormous latent selling pressure that explodes when prices begin falling. Warning sign number 5. Critical voices are dismissed or silenced. The fifth warning sign is when skeptical voices questioning bubble valuations are systematically dismissed, ridiculed, or silenced by the financial establishment and popular media. This suppression of dissent indicates rational discourse has been replaced by groupthink and social pressure. I've observed this in every major bubble, always following the same pattern. Early in bubbles, skeptical analyses are debated and considered, but as prices continue rising and bubble psychology takes hold, questioning the prevailing narrative becomes socially and professionally dangerous. Critics are labeled dinosaurs, pessimists, or people who don't get it. Their professional competence is questioned. Their motives are attacked. Most dangerously, they're excluded from media coverage and professional forums, creating echo chambers that reinforce bubble thinking. During the housing bubble, economists and analysts warning that home prices were unsustainable were actively ridiculed rather than having their arguments addressed on merit. Federal Reserve Chairman Greenspan repeatedly dismissed bubble concerns, claiming no national housing bubble existed. The financial media provided platforms almost exclusively for housing bulls, while excluding bearish perspectives. Academic economists faced pressure to avoid research undermining housing confidence. Government agencies stopped producing reports highlighting dangerous trends. By 2005-2006, questioning housing valuations publicly became professionally dangerous. Real estate agents suggesting buyers wait faced lawsuits. Economists predicting price declines found research funding threatened. This creates dangerous information cascades where absent visible dissent is taken as evidence. There's no legitimate basis for dissent. People assume if warnings had merit, more experts would express them, not understanding experts are being silenced rather than convinced. Here's why this is dangerous. Bubbles persist partly because people assume prices reflect collective wisdom of all participants. But if dissenting voices are excluded, prices only reflect opinions of people agreeing with the bubble narrative, creating false consensus. The complete framework, these 5 warning signs form a complete framework for identifying bubbles before they collapse. But recognizing these patterns requires psychological strength to stand against popular opinion and analytical discipline to distinguish sustainable innovation from unsustainable speculation. Every bubble follows the same script because human nature remains constant. The specific details change, but underlying psychological patterns are identical, making future bubbles inevitable. Looking at current markets through this framework, several warning signs are visible. We're seeing new era thinking around artificial intelligence and cryptocurrency. Credit expansion continues, exceeding income growth. Reflexive feedback loops are visible in technology valuations. Amateur speculation has reached historic levels. Critical voices questioning valuations are increasingly marginalized. The next major collapse is inevitable. The warning signs are flashing. The question is whether you will heed them or ignore them, like every generation that convinced itself it was different. Remember, markets are social systems driven by human psychology, and human psychology follows predictable patterns under stress. Those patterns are your roadmap to both avoiding disaster and profiting from disasters others refuse to see coming.